Hello, everybody. My name's Corey Kramer, and this is the Cyclical Investors Club YouTube channel. Today, I'm going to be analyzing Freeport McMoran stock. This one came in by request down in the comments section. If you have a stock you'd like me to analyze on the channel, just put it down in the comments. And if it's in the S&P 500, I post those on YouTube for free. And if it's not, I post those on Patreon and then in the full Cyclical Investing Club's service. And I'll have those links down in the description. Okay, so Freeport McMoran. I haven't looked at this one for a while, actually, and I've never written on it or put out any official videos on it, but I went back and checked in the Cyclical Investors Club chat room, and I have talked with people about it a little in the past, and I was curious what I had said, and it pretty much aligned with what I'm thinking now, so I haven't been too far, I haven't strayed too much, I guess, from my original thinking. So the first thing to check with a stock like this is these guys are mostly copper miners, like copper and gold. So they have it listed as copper here, and they do have a little bit of debt, but not a ton. And they are in the S&P 500, I think. So I've never owned it before. I have checked in on it periodically from time to time. So the first thing I check always is the historical earnings cyclicality. So this dark green area are their adjusted earnings per share. And in order to declare something, a stock, a deep cyclical, I look to see if these earnings have fallen more than 50% at some point during the past. If I shrink this, we can get the yearly kind of adjustments. So this is close to 50% during the Great Recession. For earnings, the price fell a lot more than that. Which can present opportunities for stocks like this. But then we also see earnings fall about 100% from 2012 to 2015, just slightly more than 100%. So that's definitely a deep cyclical. And then earnings did start to come back here. And if we open this up, so there's a few ways to kind of think about this. What I like to see if I'm going to invest in a cyclical business, one thing too, let's just look at the basic earnings too, because they match the stock price movement a little bit better. So you can see if we look at just the basic and not the adjusted earnings, they were deeply negative in 2008 and the stock price fell a lot, right? And then during this really negative basic earnings period here, the stock price also fell a lot. If we just go from here, I'm not even going to go up to the peak. In this 2-year time period, fell almost 90%. That's the stock price. Earnings fell more than that. Earnings fell more than 100%, using the basic version. So this basic earnings sort of tells you a little bit more accurate story probably with regard to its correlation to the stock price than the adjusted earnings. So you can see, what does the market care about? It looks like historically they've cared more about basic earnings than the adjusted earnings. So you might want to pay attention to that more. And it does show a deeper cyclicality than the adjustments that the business was making. So with that in mind, I'll go back to the regular ones. This is usually when I first look at a stock, I just look at the adjusted earnings. And because it's a long time period, and usually if a business is making adjustments that don't make sense or that are wrong, they get corrected eventually over time. So if these adjusted earnings, let's say, were just not right and they had to write down a bunch of stuff at some point later on in the future, that usually shows up later. So it could be that these adjustments that they were making here reflected wrong adjustments that they made, or inaccurate ones, a few years earlier that they finally admitted to. But what I want to see when I like cyclical business are my specialty in terms of just strategically and buying them and trading them. What I want to do is I want them to be really high quality businesses, because if a business has a lot of, usually the reason that there's cycles, there's a lot of reasons, but one reason is businesses have like a fixed overhead cost. But so let's say these guys have mines. Well, it costs them money to build and operate mines. and they have to pay a lot of those costs, whether the price of copper is high or whether the price of copper is low. So they have these fixed costs, but the commodity that they're producing and selling, the price of that can fluctuate a lot more. And that's how you get these kind of basic cycles. But what I want to see over time usually is, it might be a little different for a miner because they don't have the same sort of cycles necessarily. It's just a little weird. But normally what I want to see is higher price highs for the stock and also higher earnings highs for the business. So in this case, it would have met that standard on this down cycle here because the peaks were about equal or so, and the stock prices were about equal. So it fully recovered. That lets you know it has the ability for earnings and the stock price to recover. So the earnings recovered and the market believed it. But this last cycle didn't happen. Earnings did come up, the price did come up, but it did not make new highs. So this isn't my favorite type of deep cyclical stock to invest in. I much prefer something that has higher highs and higher lows usually, or at least at the very least like equal ones. I mean, if you look at like a semiconductor stock like Micron maybe, because they have big ones. So it's pretty similar. This 18-year was a little bit of a super cycle kind of fluke earnings to some degree. So it didn't quite get that high again. But the overall trend you can see is, if you start back here, higher earnings peak, higher earnings peak, higher earnings peak, higher earnings peak. If you forget about that one, which was crazy high, and you just use this one, then we get another higher earnings peak. And hopefully, I am long this stock, by the way. I'm not telling, it's not a buy right now, but hopefully earnings will come back and then I'll make a bunch of money on Micron because I bought it down here. And you can see that with like other semiconductor stocks, or even, something like a Caterpillar historic. I don't know if this, yes, this is a great example. So earnings high, higher high, down cycle, higher high, down cycle, higher high, down cycle, higher high, and I think we're probably going to get a down cycle, but the market doesn't think so, so I've been wrong about that one. But this is a good example of like a high quality cyclical business that is not going to fail during a down cycle, so it can give you confidence to go in and buy when it's down like 80%. So that's kind of what we want to see, and we don't really see it with Freeport. But, so what I would say is, that doesn't mean you can just disregard it, because maybe this was just like some kind of super cycle too. And that comes along, and if you go back in time, you can say, okay, that super cycle might not repeat, but we did surpass this 2018 high again on this upcycle. So maybe this is just, and this is higher than way back here, right? So you can make the case that maybe this kind of super cycle, we could ignore that, and we kind of have this new trend that we're going to be on in the future. I think that's okay case to make. But what I would say is, right now, if someone just asked me, I would say, look, it's probably fairly valued. We don't know what right now earnings are trending down, but the market expects them to come back, and they might. And it might not be a deep down cycle. It's basically been, if you averaged its price over this entire period, it's basically at that average price. So nothing is really kind of extreme in this situation. We aren't at one of these peaks where it's obvious that you should just run for the hills, but we also are not at one of these bottoms where it's obvious you should step in and buy. If I was going to buy a stock like this, I want it down near one of these lows, right? So for me, because the thing is, maybe you have to wait a long time, maybe there's more risk, but the potential reward of buying at one of these lows, if you bought in 2000, let's just claim, I'm not even going to pick the exact bottom, I'm just going to pick a random spot up here. So that's a 350% return in like 3 years. Maybe if you had to wait longer, if you bought down here and you had to wait longer, we'll just go to here, like you had to wait several years. well, you still could have got a 20% CAGR. But the thing is, you have to be willing to put up with a lot of volatility because it will be scary. And you have to buy during one of these really deep drawdowns. So for me, because even just during this little drawdown in 2022, it fell 50%. So a rough guide for a stock like Freeport, I would measure off their highs. Assume this is not a super cycle high, maybe. Like 85% off its high would probably be where I would look to buy. I mean, if you bought just not even on the bottom here, that's about 85%. And again, I'm not picking like the super tippy tops, but let's say bought somewhere close to the bottom, that's 75%. So that kind of 75 to 85% off the highs. That's where I would be looking to buy. And right now it's only 20%. So yeah. So that's, now if a person owned it and they were just still waiting, maybe this earnings comes back and they might still be able to. So it's kind of just a neutral for me, like a hold. I don't think it's super risky, but you never really know. A trailing stop might be a good idea. If you bought it during this downturn and you're like, what should I do? A trailing stop where you're like, okay, I'm going to stop it before I lose 80% over 5 years or whatever. And if it starts to really dive down, and you kind of can lock your profits in. That's the type of strategy I think a person wants to use with something like this, because it's really hard to predict what copper price is and what the earnings are going to be. There's just too many variables. And so when that happens, you want to take profits when you're near a historical peak, and then the times you want to buy is when it's absolutely crushed. Because if you bought when it was, I'll show you something here, because let's say it fell all the way down to here. You bought when it was 60% off its highs, okay, during this last deep down cycle. Okay, we're going to go to that same spot, and then we're going to go down here to, actually, let's go over here, like you waited a few years. So you're down 76%, and you've held it for 5 years, all right? You're not going to be feeling very good about that investment, even though you bought it 60% off its highs. That's probably the big lesson here. Is it's tempting to try to guess these intermediate movements like the one in 2022, but this 50% decline, if we would have had a recession, it could have turned into 80%, and that's not fun for anybody. And then usually people just cannot take that kind of pain and they get out. So because these, as you can see, these cycles aren't super predictable. This one came back fast. This one came back very slowly and needed a lot of pandemic stimulus to do it. So just be careful. Definitely protect the downside because it can be really big, and don't buy too soon during a down cycle would be my best advice here. All right. Thanks for watching, everybody. If you found this useful, click the subscribe button, and I'll see everybody later.